Okay, we're going to go ahead and get started. My name is Lorene Gilbert, CEO of WealthWise Financial. I want to thank all of you for joining us in our webinar today. We've got a lot to talk about. There always seems to be a wall of worry as far as what is going on in the world and how that is going to impact the markets. And so today I am so pleased to have, first of all, my team. Thank you, John Milligan, our CFA on staff, our Director of Investment Strategy, Carissa Adams here, who is our paraplanner, and that's who's on the call with us right now. And then we also want to thank Dave Martinez. Dave Martinez is with MFS. Dave and I have known each other for decades now, and I so appreciate his support, his input. He represents MFS in our region, and he is a wealth of knowledge. And so he's going to be presenting today. So I'm going to turn it over to Dave, and then I'm going to be intersecting as Dave talks about different things. Dave knows how I'm going to just say a few words here and there as he's presenting. And then after Dave's presentation, then I'll come back and say a few more words. As always, we are here for you. We exist. Our existence is to help you, our clients, and we are here and available for you. We very much appreciate you participating in our webinar, and we also want to hear from you individually. We're always available to meet with you one-on-one. So any questions from this, we can talk about it one-on-one. You can email us. Even during this webinar, if you want to, we're not allowed to use the chat feature. It's a regulatory issue. So instead of that, you can always email me. I'll look at my emails, see if there are any questions during the presentation. We'll address that towards the end. So with that, I'm going to turn it over to Dave.
Great. Thanks so much. I'm going to go ahead and put my slide on in the background. And I want to wait for it to pop up. I think everybody can see this, hopefully. Yeah,
yes, we can see it.
So the title of today's presentation is Market Insights Beyond the Headlines. But I want to first engage everyone by asking, when you take a look at this photo, this piece that marketing has used, I know everybody can't speak up, but do you notice anything that looks a little off? Okay. Now, when I look at it, if this were 1992, when I started in the business, this would look accurate. We don't look at the newspaper anymore, certainly not for quotes. It suggests that somehow that's how we're trying to digest our news. So what's the point? The point is today is really about trying to give this back and forth play between having the long-term vision of staying focused with our plan, but understanding news is constantly coming at us. These headlines are bombarding us. How is it that we can kind of work through that? And what are some of the most important things to focus on today? Along the way, we're going to address some of those issues, and then I'll do my best at the end between Lorene and I to answer those questions, or Lorene, whenever you want to jump in, okay? So with that said, back in 1992, the S&P 500 was roughly 400. Today, it's over 4,000. That accounts for about a 9% return. So to put that in perspective, a $100,000 investment would have become 1.5 million. Now, I can't see the attendees that are all here, but typically there's a few who might say, you know what, I'd like to think I have 30 years, but maybe I don't. I think everybody on the call has at least 20. Even a 75-year-old investor probably should be planning for 20 years out. At a 9% return, that would suggest we would see still somewhere in that 6 times growth over that period. So
Dave, that's where a lot of people forget that even in retirement, and why it's so important even in retirement to have equity exposure is that you are planning to outperform inflation. You've got to have some kind of allocation towards equities in order to outperform inflation. And so even like you said, a 65 or a 70-year-old who has, either a 30-year time horizon or 25-year time horizon, we definitely need to plan for that longevity.
That's right. And that's where the news does us no favors. The news comes at us, they're trying to get our eyeballs for today, and the net of it is oftentimes they're going to distract us. So today I want to touch on three simple topics. I'm going to address up front some political issues. I'm then going to talk about some stock concepts, and then end on bonds. And along the way, we're going to touch on a lot of different things, including inflation, interest rates. We're going to try to all get it done in about 20 minutes of formal commentary. All right, so let's just jump on it. First thing we would say is it's probably better that we separate our political self from our investor self. And what I mean by that is the market simply doesn't know our political persuasion, don't really care. That's not to say that politics don't impact companies. But what we're looking at here on this chart is that when we're looking at different forms of Congresses, so if we have a Democratic-led Congress or a Republican-led or a split Congress, I'm looking at returns here on a one-year basis for the S&P 500 going back over 70 years, 1949. Democratic Congresses got close to 12% returns. Republican-led, a little over 12%, and the split, which is what we're looking at now, has had the best. And so our take is, first, investors should try to separate themselves, their political self from their investor self. And sometimes this back and forth tension is actually a positive because it creates gridlock when it comes to companies. I'm going to pause there, see if Lauren, you had anything to jump in. I thought I saw something there.
No, really just, I completely agree. And I think that, this is where, I've seen it go both ways. I've seen, people from both sides of the aisle, especially after an election happens, there tends to be a lot of fear. If the other party, the one that you did not vote for, comes into office. And that's the point that I make is, yes, this happened whichever way it went, but that doesn't mean you have to worry that the stock market is going to be impacted because of a presidential election, let's say. That's
right. That's right. Now, that said, it doesn't mean we have our head in the sand. As an asset manager, and I probably should have said this up front, MFS is very well known within the industry for having created the first mutual fund about 100 years ago, 99 to be exact. Our acronym MFS, as you see in the upper right-hand corner, stands for Massachusetts Financial Services. So we take our job very seriously, and it's not like we're dismissing politics. Our approach, though, may be very different from what we typically hear from investors. Investors oftentimes want to wait it out. They want to sit on the sidelines until something very decisive happens. We're quite the opposite. What we're going to do is we're going to say, what do we know? What do we know about this business? And what do we know about the political party or the potential winner of a presidential election? And what might, therefore, the policies be? And then we create our sales and expected earnings models for these companies, and we weight them. So what we'll do is, in looking at that, we'll see those companies that are more politically sensitive, they're going to have a wider variance of expected outcomes, really good, really bad. Those companies that seem to be more impervious to the current politics are going to have a tighter band. Everything else being equal, we'd rather invest in companies that have less impact from politics. So we have a risk control measure. It's just not necessarily what most investors are thinking, getting in or getting out and trying to time this thing. It's a fluid long-term process, okay? So the one issue that's been on the minds of a lot recently regarding politics has been the debt ceiling. If you were to ask Mr. Market, Mr. Stock Market, what's it thinking? It's actually feeling like we're going to get past this debt ceiling without any major issues. Only time will tell whether or not that happens, okay? Our take is there's been over 100 times that the debt ceiling has been raised since the end of World War II. It will probably happen again. But what we're likely going to get as we approach that X date, which is the date that the Treasury runs out of money relative to its tax receipts, is more and more volatility. But in the last few days, it looks as if the market's anticipating a solution, but it's still relatively early days in this. history says this is probably going to come down to the 11th hour, and don't be surprised if we continue to see volatility on this.
Yeah.
Okay.
And I would just add in here, Dave, that, the good news is that June 1st is that expected date. And frankly, I think Yellen is using that date as a premature date in a sense, just to make sure that this thing gets resolved before there are any issues. And she keeps saying it every day, June 1st, June 1st. So with that, Congress and the White House, neither one of them want us to go into default. There's no way that either side wants us to go into default. So with that is why negotiations are taking place. And the other thing I'll add is that I do think that once it's resolved, I think we're going to have a temporary bump up in the markets just as a result, as somewhat of a relief.
Right. So let's jump onto the stock side of it. As a reminder, it's worth asking ourselves what actually drives stock prices long term. A lot of times the answers I get in an in-person audience might have something to do with politics or some kind of relationship, maybe a new product. To us, it boils down to something even simpler than that. It's earnings, it's profitability. We are investing in an actual company. Companies typically are more valuable once they have more profitability, especially if that profitability is expected to grow. So for us, what we focus on are companies that we believe are going to have a successful and visible earnings pattern driven by sales growth down the road for several years to come. Remember, stock means you have an ownership in a company. It gives you rights to the dividends. It gives you the ability to vote for these companies. And ultimately, it gives you the access to benefit from capital appreciation. As we're looking at these stock prices, oftentimes these short-term price fluctuations are more emotional because there simply isn't that much more data on the company. They only release earnings once a quarter. So all that's happening in between is really just kind of jockeying around, oftentimes based on emotions. But if you look longer term, US corporate profits and stock prices for the S&P 500 have tracked pretty closely to each other. They're never exactly right on top of each other. If they are, it's not for long, but you can see they kind of do this wiggle between each other over time. Sometimes one gets ahead of the other and moves on. Yep.
One comment on the emotion. Another way to say that too is just sentiment. So as sentiment varies, so do stock prices. So you could use that in a sense as well. Sentiment and emotion can have that short-term impact, but like you said, the long-term impact is following those profits.
Right. So let me give you a few different examples of some stock ideas that we're continually getting attracted to. The takeaway hopefully here is there's a lot of different ways to make money. In the short term, the sentiment can change, but longer term, there's reasons why these stocks should move higher. It's typically because of growth, need, demand. We're spending our hard-earned money on this type of stuff. On the first one, I can say I don't personally spend a whole lot of my hard-earned money on this one in the upper left-hand corner. What that represents is actually e-gaming, so electronic gaming. It's a growth market. It's roughly a $150 billion market. It's expected to grow by 20% per year over the next 7 years. That is a very fast growing market, whether it's this or artificial intelligence, or just the ability to actually provide all of this. We think there is a lot of different ways to play this. So you could be looking for these gaming companies that sell the actual product. I mentioned AI that's out there for years to come, or it could be more of a picks and shovels approach, where you're really just looking to buy the semiconductors and all the different software that's used to develop the software, the semiconductors, to do the computing that goes behind the games or the artificial intelligence. That's one example of a growth stock. On the other side, in that tower, that's an example of just the visual that we need more data. We believe you're going to continue to have more data. This data could come in the form of real estate investments that are buying these towers We all want the data. We just don't want them necessarily in our backyard. And so there is a monopoly on these. These companies oftentimes have price escalation built into their contracts. So their sales should automatically grow through price appreciation through inflation. And they're usually a bit of a monopoly on that market. So I'll pause there for a second just to see if Lorraine wants to add anything more before I hop onto the value side.
No, what I would say is exactly to your point that we like both. It's not an either or. There can be tilts, and we do tilt between growth and value. But what we see is we see a lot of opportunities in AI, and we are following that trend. And then on the value side, absolutely, various forms of infrastructure, which is part of value, is also an important investment theme.
Yeah. So let me build on that a little bit more. I hear for whatever the reason, almost as if energy and the need for energy has become politicized. Fossil fuel on one end, renewable on the other end. All the expectations of global demand for energy that I've seen reports on are saying we need more, period, no matter how we get there. So over the next 20, 30, 40 years, the expectation is the world is going to want more power. It's going to come from it's going to come from fossil fuel. We'll continue to have some elements of coal. We're going to have renewable try to add more additional power, but it's the fossil fuels that are actually going to help build out that renewable energy source in the future. So for us, we think not only is there going to continue to be this diversification of energy production, but also this focus on of energy efficiency. So companies that are going to help make air conditioning as something as basic as that more energy efficient should benefit. Companies that are going to be able to deliver the power grid that we need so we can have renewable energies and electric cars, they're going to benefit. And those are oftentimes found in this value space. So I'll leave it at that. Okay. What role can international play? So international, this is a bit of a busy chart, so let me walk you through it. When I'm talking about international, I'm talking about international stocks that are headquartered outside of the US versus companies in the S&P 500 that are headquartered inside the US. We would be the first to admit that both of these companies are oftentimes multinational sales companies that are selling all around the world. But for this example, what we're trying to stress is if we compared international versus US, there are definitely periods when one has done better than the other. So here's what we're looking at. These periods right here that are shaded, or when these lines are above the zero line, these dark blue lines are above the zero line, that's when the non-US MSCI EFA index has done better. So you can see there were periods in the early 90s, late 90s, but most of the outperformance came in the 2000 to 2010 period. And we've had a big drought of international outperforming, really only about a couple of years in the last 10 years. Why do we believe that moving forward, international is poised to do well? I'll give you just a handful of reasons. First is valuations are more attractive, but valuations by themselves don't necessarily make for a better investment. What's the catalyst? History said that when you've had recessions, like we had here in the global financial crisis here, or we had in the tech wreck here, or we had in the Persian Gulf War here, those recessions oftentimes resulted in change of leadership, which is what we think we're having right now with US versus international. We also look at the composition of non-US companies. They include a lot of the industrials that I mentioned, financials, basic material. Those are going to be needed for infrastructure build out. And a lot of those companies tend to be headquartered outside of the US. You couple that with the dollar likely being at around 20-year highs, likely trending back to the average. We think the setup is there for international outperform, but we'll leave you with this. Don't go crazy about it. It's still just a diversifier. We're, I think on this call, all US-based investors who probably should still have the majority of their money here in the US. So Lorraine?
Yeah, the only thing I would add, we absolutely came into this year with an increased exposure to international for all the reasons that Dave just described. And so if you really look at what we've been talking about, our economy slowing, most likely going to recession here soon. And then you look at that lost decade of the 2000 and how much outperformance there was in international. And we think we could be going into a period that is somewhat like that. So we look at that, all those reasons, and the dollar, we absolutely agree, has rolled over and is weakening. And that all makes sense because as the interest rates were going up, then the dollar was especially strong. And now that we're getting to a place with the Federal Reserve where we're going to be pausing either soon or have already started, then, similarly, we see that the dollar weakening there. So we especially like the developed international play and have increased that exposure.
So before I switch to bonds, I'll make this last comment about the dollar because it oftentimes comes up. To be clear, we think the dollar will weaken relative to other currencies. That's just normal trading that happens over longer periods of time. But we don't believe anytime in the near future or even medium to distant future that the dollar is going to be replaced somehow by another currency. We believe it'll continue to be the ultimate currency for business getting done. Okay.
Yeah, and we've seen that over and over again when there have been crises like the pandemic, how the dollar was once again the safe haven. So for those people who are concerned about that, the dollar continues to be a reserve currency. That is one of the reasons why we have to get this debt ceiling issue resolved, is so that the dollar remains that reserve currency.
All right, so let's bring it home in talking about bonds. I like to use a bad, corny joke. What's another four-letter word for bonds? Just as a reminder, I can actually think of two four-letter words. One is loan and one is a debt. Okay, so loan and debt. And what am I driving at? Bonds are, as a reminder, a loan or a debt issued by some municipality to build bridges or sewer lines, or a company to build a factory, or a government, in this case, to fund any of its spending or social services. So these are what we buy when we buy bonds, but there's a lot of different types. As you see here on this chart, if you look down here on the lower side here, USHY stands for high yield. US high yield, these are lower quality bonds. You see all different versions in between as we go to the right. You see global high yield, then munis, and global investment grade, US investment grade, emerging markets debt. And as we get to the far right-hand side, you get US aggregate and US treasuries. The takeaway is this: there's lots of different types of bonds, but on the far end, you have one that's more credit sensitive to what happens as the economy grows or shrinks, okay, expansion or recession. And on the far right-hand side, the most stable, probably the highest rated, and that is this US Treasury. Its risk historically has been more inflation or interest rate sensitivity. It's our belief that investors should have a diversified portfolio of all of them, but there are different times to have, say, high yield. It's our belief this is not one of the times right now, as we're going into recession, to have a lot of high yield. We have that portion of the portfolio underweighted. Doesn't mean we've eliminated it entirely. We just have it underweighted. Because what will likely happen is you'll see defaults increase as we go into the end of this year. What we're doing in the meantime is waiting into things like US Treasuries that have higher ratings. And then at some point, we'll see the opportunity to sell some of those treasuries and then go buy those lower quality investment bonds. Maureen?
We would agree on improving credit quality as we see the economy slowing. The one area that we still have some exposure would be in the municipal high yield space, which we think is different than having corporate
Absolutely.
high yield. So, and in fact, that's MFS's municipal high yield. So it is something that we like, and maybe Dave just explaining the difference between that.
Yeah, so the first thing is that the major difference between high yield, which are corporations, and municipalities is municipalities often, in most cases, have the ability to tax. So there is already a fundamental difference. They can, municipalities have the ability to raise some money. High yield has to go straight for sales. Also, municipalities have had such a higher rate of paying back their bonds entirely. It's very rare that we ever have defaults. It's not quite as rare in high yield. And then lastly, the way that we build our portfolio, it's both a part high yield as well as investment grade. So we actually create one of the most conservative versions of a high yield, higher income product, because we believe that investors that buy municipal bonds still it's about staying rich, not about getting rich, but trying to maximize the income.
Yeah. The only other thing I want to say here about fixed income is that we actually see quite a bit of opportunity in the fixed income space. So, you know, just a few years ago, we didn't have much yield at all in the fixed income space. And I think you're going to go into this, Dave, a little bit. Mm-hmm. And now things are completely different. So with that, we now see a huge opportunity in fixed income. So where even as we go more conservative in a portfolio tends to mean more fixed income, we also see quite a bit of opportunity. So there's a way here to actually capitalize on having more fixed income, being somewhat more conservative, and yet still having good opportunity.
That's right. So let me, actually, you know what? We could go straight to this next piece here. I'm going to stop sharing here, and I'm going to close by sharing these other two ideas, and then we'll turn it into questions. So I get asked, Lorraine, could you? Yeah, you
I can see it.
Let me just move this here. So I get asked nearly every single day for the last 6 to 12 months, how do you say no to a 5% CD? And my answer has been, how did you say no to an 11% CD back in 1984? But you should have. And I'll explain to you why in a minute, and have you start to think about this mindset of buying more bonds in short. Okay. So here's what we're looking at. We're looking at this piece that we call worried about inflation. You probably should be. And the reason is, in short, inflation has robbed our purchasing power. So let me first explain what we're looking at, and then we'll come back to this 5% CD concept. On the far left-hand side, what we see are calendar years. What you'll see under this column is a 6-month CD rate, which is average 1.08%. You can see that right here. After federal taxes of 22%, the after-tax return was 84 basis points, or 0.84%. Unfortunately, inflation during these 10 years is running at 2.6%. So you are actually losing minus 1.81%. Now, I use this bad joke just as a way to help people remember this. And I joke that CDs are like smoking, and the longer you do it, the worse off you are. And what I'm driving at is they're not really an investment. They're more of a savings instrument for the short term. $1,000 put into CDs after taxes and inflation actually lost 17% of purchasing power in only 10 years. So that's not an investment, but it does serve a purpose. The purpose, as a reminder, is to be able to have money readily accessible at a specific dollar amount for what we might probably are going to spend in the next 2 or 3 years or less. Okay, so they serve a purpose, but they don't necessarily serve as a substitute for bonds long term. Longer term, the only way to have gotten ahead of that of investing in inflation was really not through CDs. This number does not include taxes. You really needed to be invested in bonds, as you can see here, or stocks. Okay, so let me go back to that 5% number just to make sure we're all on the same page. Here you can see we had 6-month CDs just at the end of last year at 5.2%, and inflation was running at 6.5%. So let's fill in these numbers. If we wrote right here 5.2% under the 6-month CD, after taking out 22% in taxes, we'd be left with 4%. Okay, but with inflation running at 6.5%, 4 minus 6.5 meant that we were actually running a real return of minus 2.5. Minus 2.5 would have been one of the worst returns in the last 10 years. And that's why even something that looks so attractive as 5.2% on the CD really still maintains the same idea that it's not a long-term investment. It's just a way to have short-term money sit until we need to spend it in the next couple of years. Laureen, want to add anything?
Yeah, the thing I want to add here, most people on this call are paying more than 22% taxes. So when you add in all the taxes you're actually paying, then those numbers look, even worse.
Even worse. All right. So what about that 11% CD back in 1984? And more importantly, what about now? Okay. So right now we may be on the precipice of a rate pause by the Fed. The last 6 times the Fed stopped raising rates, what happened with CDs versus short-term bonds or core bonds or corporate bonds? Well, here's what happened. This goes back to 1984, 89, 95, 2000, 2006, and 2019. The last 6 times the Fed stopped raising rates, and what happened to returns for the next 12 months. In August of 84, if you bought the 11% CD, you would have made 11% over the next 12 months. But had you bought a short-term bond fund instead, you would have gotten closer to 20%, core plus over 20%, and corporate bonds also over 20%. Now, to be clear, it did not work that impressively every single time. In 89, it was pretty similar. But in 95, 2000, and 2019, it did. So why? The reason is traditionally the Fed, within that first 12 months of stopping rate hikes, usually starts rate cut cycles. And as they start to, or as even the market starts to get wind of it happening, the market recognizes those CD rates are coming lower, and we want to lock in those bond yields if we can. So lengthening the maturity, lengthening the duration, in our opinion, is timely right now. If you look at the last 6 months, for example, the peak in the 10-year Treasury happened in October of last year. It went in the last 6 months as low as 3%. It's right now sitting around 3.7. So it's trending lower. To us, that tells us that inflation is likely continuing to trend lower, which it certainly has. It's gone from over 9 to under 5. And that we think this is a good time where the trend is your friend, that bonds will likely continue to see lower yields, means price appreciation. So we should consider lengthening duration, maturity, and locking it in. Laureen?
Yeah, I'd like to add that we've already done that. So we actually increased our duration at the beginning of this year. And, that is, or during the first quarter, and that is, has been a good move because we agree that we are, like I said, the Fed is either on a pause or maybe they have one more rate hike, but increasing duration is the right move. And, that is why you want to have some bond exposure. Certainly those CDs are a good short-term vehicle for money that you might need in 6 months or whatnot. But as you're looking at money that's longer term, adding into the mix, having those bonds in there, we think is a good move and is part of our overall portfolio allocation.
Right. So in closing, let's kind of pull it all together. The news isn't our friend if we let it just continue to grind us down. I have this belief that as humans, we're wired to only get so much bad news before it eventually wears us down. I think as investors, we can only handle so much bad news before we're compelled to make some change. And oftentimes it's not for the better. So from the big picture, remember, stocks are driven by success of their profitability long-term. Bonds can be a great buffer. We haven't seen these yields in the last 10 to 15 years. There's as attractive as they've been in the last 10 to 15 years. And we're all 10 to 15 years older. So it shouldn't come as a shock that we should be asking ourselves, should we own a little bit more in bonds since it's the best yields we've seen in 10 or 15 years and we're all a little bit older? I think that's a fair question, right? And lastly, we're going to continue to go through these political issues. If it's not the debt ceiling, it's going to be an election. If it's not one of those two, it's going to be something else, unfortunately. We have to stay focused on our plan and remember that ultimately that's part of that wall of worry that Laureen opened up this commentary on, and we'll get over it. Okay, so with that, I want to thank Laureen. Laureen, I would love to say that all advisors are doing this, but it's not the case. We're big believers that an educated investor makes for a better investor. The fact that you're offering these is terrific. We think it's going to ultimately help your clients become better investors. So appreciate the time. Oh.
Thank you, Dave, so much for the great presentation. And yes, we want all of you to be educated and know what you're invested in. That's what we are here for, is to help you understand more about the markets, understand more about the business cycle, understand more about what you're invested in. And ultimately, and the most important thing, is making sure we know and are helping you with your goals. So we're very goals-based and helping you make sure you're going to reach your goals, and doing everything in our power to help you understand what that is and what that looks like. So, once again, we're here to help you and to answer your questions, to help you both with the wealth management piece and the financial planning piece, and with that, to educate you. So we do offer these monthly webinars. Every month we're offering a different topic, and we greatly appreciate you joining. I looked at my emails. I haven't seen anything come across as far as any questions. So I don't see any questions here. However, please feel free to email us, give us a call. We're happy to meet with you one-on-one. Thank you for joining, and we'll hopefully see you again next month.